You are sitting at your kitchen island on a Tuesday afternoon, coffee going cold beside you, scrolling through a real estate forum on your laptop. Someone just posted that detached homes in Brampton dropped another 4% last month, but you are not worried. You got pre-approved in the spring. Your agent told you the market is stabilizing. You have done the math. You are ready. Then your phone buzzes. It is your mortgage broker, not a text, an actual call. You pick up, and the first words out of his mouth are not congratulations. They are, the appraisal came in short, not by a little, by $87,000. Your stomach does not just drop, it free fall. Because that number is not an abstraction. That number is the exact amount of cash you do not have sitting in a savings account somewhere. That number is the difference between owning a home and losing your deposit. And the worst part, the seller is not budging. The bank is not budging, and the clock on your financing condition expires in 48 hours. Welcome back to Canada Property Watch. In our previous investigations, we exposed how the CRA's data surveillance infrastructure is systematically flagging property owners who claim the principal residence exemption on homes they never actually lived in, triggering forensic reassessments going back a decade. We also broke down how the self-supply rule under the Excise Tax Act is silently detonating the finances of Ontario builders who thought they understood HST. Today, we are going somewhere different. We are not talking about audits. We are not talking about tax. We are talking about the mechanism that is quietly killing deals across 5 specific Ontario cities before buyers and sellers even realize the market has turned. We are talking about the appraisal trap, and if you own property, are trying to buy property, or are sitting on a mortgage renewal in any of the cities we are about to name, this video is not optional viewing. Here's the first thing you need to understand, and it is the thing that almost every real estate headline gets catastrophically wrong. Average prices lie. Not intentionally, not maliciously, but structurally, by design, in a way that consistently misleads the people who rely on them the most. When you see a headline that says the average detached home price in a particular region dropped 3% last month, that number is calculated across every transaction that closed, regardless of what type of property sold, in what condition, in what micro-location. If more entry-level townhouses sold this month than luxury detached homes, the average drops even if the price of each individual property type stayed exactly the same. This is called compositional drift, and it creates a statistical illusion that masks what is actually happening on the ground. The more forensically accurate measurement is the home price index, which tracks the same type of property in the same geography over time. It strips out the noise of what happened to sell this month and asks a cleaner question. If you sold the same house today that you sold a year ago, what would it fetch? And when you run that analysis in certain Ontario markets right now, the numbers are not 3% down. They are 12, 15, sometimes 18% below their peak. Is your area falling or holding? Comment, fall or hold right now. Because the answer to that question determines whether the next part of this analysis applies to you. Here is where the trap actually lives. Most buyers, most sellers, and frankly, most real estate agents are watching the average price number. They are using it to estimate what a property is worth, what they should offer, and what they can borrow. The bank is not. The bank's appraiser is running a completely different analysis, one that is specifically designed to be conservative, one that is anchored in recent comparable sales in a tight geographic radius, and one that is updated in real time as the market moves. And when a market is falling fast, the appraiser's number and the agreed purchase price begin to diverge. That divergence has a name. It is called the appraisal gap, and it is the precise mechanism by which the appraisal trap executes its victims. Here is how the sequence unfolds. Listing prices in a cooling market tend to lag. A seller who bought in 2021 and is trying to sell today still has a number in their head. They anchor to what their neighbor got 18 months ago. what Zillow estimated 6 weeks ago, what their agent said the market would bear. So the listing price stays high while the actual transaction market underneath them is quietly deteriorating. A buyer comes in, offers something close to the list, and the deal is accepted. The buyer goes to their bank. The bank sends an appraiser. The appraiser is not looking at the list price. The appraiser is looking at what similar homes actually sold for in the last 60 to 90 days. And in a fast-moving downward market, those comps are lower, sometimes dramatically lower. The bank will only lend against the appraised value, not the purchase price. If the appraised value is $80,000 below what the buyer agreed to pay, the bank's loan is calculated on the lower number. The buyer must now either produce that $80,000 in additional cash, renegotiate the purchase price downward with the seller, or walk away and lose their deposit. In a market where buyers are already stretched, where down payments were assembled over years of saving and are sitting at exactly the minimum threshold required to qualify, that additional cash requirement does not exist, and so deals collapse. When closing failures start accumulating in a specific area, something mathematically inevitable happens. Days on market begin to extend. Sellers who cannot close their deals start reducing prices to attract buyers who can actually get financing. Those price reductions become the new comparable sales that future appraisers use, which means future appraisals come in even lower, which triggers more financing failures, which produces more price cuts, which become the new comps. This is not a slow erosion. This is a self-reinforcing spiral, and once it achieves sufficient velocity in a specific market, it does not stop until price reaches a level where the appraisal gap closes. That closing point is determined by the bank, not by the seller, not by the agent, not by the buyer. The bank decides when the math works. And right now, in 5 specific Ontario cities, the bank's math is executing a systematic destruction of deal flow that most people caught inside it never saw coming. Stay with me, because this next part changes everything you think you know about where the trap is actually closing. The first city is Brampton. This is not a surprise to anyone who has been watching the data, but the mechanism in Brampton is more specific and more brutal than most people realize. The issue is not simply that prices are down. The issue is the concentration of buyers who entered the Brampton market between 2020 and 2022 at the absolute peak of leveraged purchasing, using extended amortizations, co-signed income structures, and in some cases, down payments that were gifted or borrowed in ways that stretched their gross debt service ratios to the absolute maximum permitted under OSFY's B20 stress test. Those buyers are not selling because they want to. They are selling because their renewal dates are arriving and the arithmetic no longer works at current interest rates. When a seller is distressed and a buyer cannot close because of an appraisal gap, the transaction fails. When transactions fail repeatedly in a dense urban corridor, the bank's internal risk models flag the postal code. Appraisers working in flagged postal codes apply additional downward pressure to their valuations. This is not conspiracy. This is standard credit risk management. The result is that in certain Brampton micro markets, the gap between list price and appraised value is now running between 6 and 12% on detached homes, which translates directly into a financing wall that most buyers simply cannot climb. The second city is King Township. King operates differently because its price decline is being driven not by distressed sellers, but by a buyer withdrawal, the luxury and semi-luxury segment of King, the 2-acre lots, the custom builds, the executive homes in the $800,000 to $1.4 million range, depends heavily on buyers who are wealthy on paper, but whose wealth is tied up in other real estate. When the broader market softens, that equity base contracts. The buyers who are going to trade up into King are holding positions they cannot exit cleanly, so they pause. And when buyer volume collapses in a low transaction market like King, the appraisal problem becomes extreme, because there are simply not enough recent comparable sales for appraisers to anchor their valuations. In the absence of recent comps, Appraisers default to conservative methodology. In a market that was already elevated relative to income fundamentals, conservative methodology produces appraisals that shock everyone at the table. Sellers in King who accepted offers in the fall are finding at the financing stage that the bank sees the property as worth substantially less than the agreed price. And unlike Brampton, where the buyer pool is broad enough that a price renegotiation might find a new buyer relatively quickly, in King the buyer pool is thin. When a deal falls apart in King, the property can sit for months before another qualified buyer appears. The third city is Whitchurch, Stouffville. This one is particularly instructive because Stouffville represents a specific category of trap that we might call the commute shift casualty. During the pandemic, the logic of buying in Stouffville was straightforward. Remote work made distance irrelevant, square footage became everything, and prices in York Region's outer municipalities looked attractive relative to what the same money bought in the core. Buyers moved north, paid peak prices, took on large mortgages, and built their financial plans around the assumption that remote work was permanent. It was not. Corporate return-to-office mandates, first partial and then increasingly firm, have been shifting commute calculus back toward the core since late 2022. The demand premium that Stouffville captured during the pandemic is unwinding. Buyers who need to be in downtown Toronto 3 or 4 days a week are no longer willing to absorb the commute cost, and that unwillingness is showing up in transaction prices. The appraisal gap in Stouffville is being driven by a specific temporal mismatch. Sellers are still pricing at 2022 logic, while the market's buyers are operating on 2024 and 2025 logic. The appraiser, anchored to recent comps, is firmly on the buyer's side, and if you've had a low appraisal recently, comment low plus your city. I want to see exactly where this is hitting hardest. The fourth city is Richmond Hill. Richmond Hill presents a structurally different version of the trap. Unlike Brampton, where the issue is concentrated in the entry and mid segments, and unlike King, where it is concentrated in the luxury segment, Richmond Hill's appraisal problem is spread across a wide price band and is being intensified by a specific dynamic in its investor-held condo and pre-construction segment. Richmond Hill has a significant inventory of pre-construction units that were purchased at 2021 and 2022 prices and are now closing at a moment when market values are materially lower. When a pre-construction condo closes, the buyer must secure financing based on the current appraised value of the completed unit. In a market where condo prices have pulled back significantly from their peak, the current appraised value of a unit that the buyer contracted to purchase at peak pricing creates an appraisal gap that is not measured in thousands. It is measured in tens of thousands, sometimes in 6 figures. Buyers who purchased at peak pre-construction prices in Richmond Hill are arriving at the closing table and discovering that their bank will not lend them the amount they need to complete the transaction, because the unit is not worth what they agreed to pay for it. This is not theoretical risk. This is an active problem closing in real time across multiple Richmond Hill projects. When those buyers cannot close, the developer faces bulk closing failures, which triggers its own cascade of legal and financial consequences that we will address in a separate investigation. The fifth city is Newmarket. But Newmarket's version of the trap is the most operationally precise of the 5 because it involves a direct collision between OSFY's income requalification requirements at renewal and the appraisal-dependent calculation of available equity for those trying to refinance. A homeowner in Newmarket who bought in 2020 with a 5-year fixed mortgage is now approaching renewal. If they want to refinance, access equity, or switch lenders, the new lender will order an appraisal. If that appraisal comes in below what the homeowner assumed their property was worth, their loan-to-value ratio changes. If the loan-to-value ratio moves above 80%, they now require mortgage insurance through CMHC, which triggers a full income requalification under current stress test rates. On a household income that easily qualified for a mortgage in 2020 at historical stress test levels may not qualify for the same mortgage today at current stress test rates. These homeowners are not behind on payments. They are not in arrears, but they are trapped. They cannot refinance at favorable rates because the math does not work. They cannot access their equity because the appraised value does not support it. And their renewal options are constrained to lenders willing to work with their existing loan-to-value position, which typically means higher rates, not lower ones. Now, the critical counter-argument, and it is one worth addressing directly because it is the argument that will make a certain segment of viewers feel safe when they should not. Certain parts of the Toronto core have not experienced the same downward appraisal pressure. Specific high-demand neighborhoods in the inner city, particularly those with constrained supply and significant wealth parking demand from high-net-worth buyers, have demonstrated resilience. This is true. But resilience in the core does not neutralize the trap outside the core. What it does instead is create a market fragmentation that makes the appraisal problem harder to see and easier to misread. When you see a headline citing strength in Toronto real estate, you may be reading data that is being carried by 20 postal codes while 300 postal codes are declining. The average masks the disparity. And the buyers and owners in the declining postal codes who read the strong headline and conclude they are safe are precisely the people who arrive at the closing table or the renewal appointment or the refinancing meeting and discover that the bank's appraiser has been watching a completely different movie than the one the headlines were showing. Here is what the actual execution of the appraisal trap looks like from the inside. A buyer in one of these 5 cities negotiates a purchase and receives a financing pre-approval. The pre-approval is not a guarantee of financing. It is a conditional commitment based on the assumption that the property will appraise at or above the purchase price. When the appraisal comes in short, the bank does not call the buyer and negotiate. The bank issues a revised commitment letter stating the maximum loan amount against the appraised value. The buyer has to figure out the rest. If the buyer cannot figure out the rest and walks away, the seller relists the property. If the market continues to deteriorate between the first failed closing and the new listing either sits longer or closes at a lower price. If the seller was using the proceeds of the sale to fund their own purchase somewhere else, their transaction chain collapses. Multiple families, multiple financial plans, multiple life decisions, all hanging on one appraiser's number. The escape routes exist, but they are narrow and they require preparation that most people are not doing. For homeowners in these markets who are approaching renewal or considering a sale, the first and most important action is to stop using average price data to estimate your property's value and to start tracking actual closed transaction prices for your specific property type in your specific street-level geography. This means looking at what your immediate neighbor sold for in the last 60 to 90 days, not what the neighborhood average is. If that data is moving against you, you need to know before your renewal appointment, not at it. The homeowners who are getting destroyed right now are the ones who walked into their renewal meeting with a mental equity number built on peak market assumptions and discovered in the meeting that the bank sees a completely different picture. The ones who survive are the ones who already know the bank's number before they sit down, which means they arrive prepared to have a conversation about solutions rather than absorbing a shock. For buyers who are still active in these markets, the appraisal gap is a negotiating tool, not just a risk. If you are making an offer in Brampton, in King, in Stouffville, in Richmond Hill, or in Newmarket, the financing condition in your offer must be structured to protect you specifically against an appraisal shortfall. This is not a standard condition. It requires specific language and it requires a broker who understands how to draft it. A generic financing condition does not protect you if the appraiser comes in short, and you could technically still borrow the money at a higher loan to value with mortgage insurance. You need to understand the exact terms under which your deal can unwind without penalty, and you need to negotiate on that basis. Equally important, build a cash buffer for the appraisal gap before you make the offer. Know exactly how much shortfall you can cover out of pocket and structure your offer so that you are not in a position where closing depends on a number you cannot control. For the investors and the highly leveraged property holders in these markets who are watching this video and feeling something uncomfortable right now, that discomfort is appropriate. The mechanism we have described today does not only affect buyers trying to close deals, it affects the appraised value of every comparable property in the vicinity every time a distressed transaction closes below asking. Each failed deal, each price cut, and each fire sale closing becomes part of the comparable sales data that appraisers use to value the next property in the area. You are not insulated from your neighbor's distress. Your neighbor's distress is mathematically connected to your appraised value. And your appraised value is what your bank is watching every time your loan-to-value ratio comes under review. The appraisal trap is not something that happens to individual unlucky buyers. It is a market-wide mechanism that executes systematically once enough transactions begin to fail. And in the 5 cities we named today, the transaction failure rate is not a distant early warning signal. It is an active operational condition. What happens after the appraisal gap closes a deal? What happens to the buyers who did manage to close, but closed with more debt than they should have carried, at prices the market is now revealing were too high, on mortgages that are now coming up for renewal at rates their income cannot comfortably support? That is the next trap in the sequence. That is the renewal denied scenario, and it is where the appraisal trap survivors discover that escaping the first mechanism only placed them inside the second one. We have an entire investigation dedicated to that exact sequence. If you want to understand what happens after the appraisal gap, that video is waiting for you. Before we get there, one question for the channel: what do you want us to investigate first? Comment appraisal if you want us to go deeper into how banks are internally flagging specific Ontario postal codes for heightened appraisal scrutiny. Comment renewal if you want us to move directly into the renewal denied scenario and show you exactly how the math executes at the moment a lender declines to renew on existing terms. Your answer determines where this investigation goes next. Canada Property Watch. We do not guess, we document.